Hello, everyone, and welcome to the second session of our three-part Tax Saving Tips for Working Professionals webinar series. Today's session will cover how understanding what tax planning strategies fit your needs as a working professional. It will be recorded and posted to our website in case you'd like to reference back to any of the concepts we discussed today. If you haven't done so already, I highly recommend going back and watching our first webinar. It'll provide a lot of context for today's discussion and help clarify anything that we covered today. I'd like to start by introducing myself. My name is Kyle LaBelle, and I'm a financial advisor with Milestone Financial Planning. Milestone is a fee-only financial planning firm based out of Bedford, New Hampshire. We have additional offices in Peterborough and Newmarket, New Hampshire, as well as Westford, Massachusetts. We are an investment management firm that helps clients around the country with their financial and tax planning needs. You can connect with me on LinkedIn and learn more about Milestone by visiting our website at milestonefinancialplanning.com. A few disclaimers before we begin. Nothing you hear today should be considered tax, financial, or investment advice. Do not make financial or investment decisions based on this or any other webinar. Instead, meet with a qualified financial advisor regarding your specific goals and financial circumstances before making major financial decisions. Note that almost all financial decisions will impact your income taxes or estate taxes now or in the future, and the tax consequences should be evaluated before you take action. Past performance of investments does not predict future results. Advisory services are only offered to clients or prospective clients where Milestone and its representatives are properly licensed or exempt from licensure. If you have any questions, please feel free to contact us at info@milestonefinancialplanning.com. Our webinar series covers tax saving tips for working professionals. The first session introduced how the U.S. income tax system worked and many of the tips and techniques that we'll discuss today. Today's session is designed to elaborate on those techniques and help you understand which ones fit your needs as a working professional. The third and final session in the series will be on August 15th at 4 p.m. It will cover how to build your own tax plan. If you have any questions on Milestone's events, you can reach out to us at events@milestonefinancialplanning.com. Without further ado, let's get into the meat of today's webinar. The first topic we'll cover today has to do with choosing between a traditional or Roth contribution to your retirement account. This is one of the most common issues and planning topics for working professionals, and choosing the right option can have a huge impact on your financial situation. Let's start by reviewing the difference between the two of them. Traditional contributions reduce your W-2 income today. That means that you're going to pay less in taxes today by putting money into these accounts. These accounts grow tax deferred, which means that you're not going to pay income on taxes on any income generated within your traditional account each and every year. Withdrawals are taxed at ordinary income rates, and they are subject to required minimum distributions. It usually makes sense to choose a traditional contribution if your tax rate is higher now than when you withdraw funds in the future. On the other hand, Roth contributions are taxable today. That means you don't get a tax deduction for putting money into your Roth accounts. They also grow tax deferred like traditional contributions, and withdrawals from Roth accounts are tax-free after the age of 59.5. This provides a huge benefit over traditional accounts and helps increase your overall tax flexibility, which is something we'll cover throughout today's webinar. Roth accounts also are not subject to required minimum distributions, which is another benefit of these accounts. It usually makes sense to choose a Roth contribution if your tax rate is lower today than when you take money out of these accounts. That's because you will likely have paid less in taxes today than what you would have paid later on. While this is a great framework, it can be difficult to know if your taxes are lower now or later, because there are many different factors that impact that outcome. One of the key factors is the presence of required minimum distributions. RMDs have a major impact on your traditional versus Roth decision, and they're the reason for many different planning opportunities that we're going to talk about today. So in exchange for receiving that tax deduction for contributions to your traditional pre-tax retirement accounts, you must start taking money out of those accounts in the future. This is what's known as your required beginning date. After that point, you have to take money out of your pre-tax accounts each and every year. This added to your Social Security, pension, and other retirement income could easily put you into a much higher tax bracket than you were in during your peak earning years, and has a huge impact on whether you should have chosen a traditional or Roth contribution. RMDs cause pre-tax accounts to become ticking tax time bombs, and as I mentioned, have a huge impact on whether you should choose a traditional or Roth contribution. You really need to have a sense of what your overall tax situation is when making this choice. Now let's look at an example of how RMDs work. In this example, we have a retired couple that are turning 73 this year. That means that they should start taking money out of their pre-tax retirement accounts. They also have $95,000 in combined Social Security income, and each of them have $2 million in a traditional IRA at the end of last year. Now, if we do the RMD calculation, we figure out that each of them has to take out a little over $75,000 from their pre-tax account. If we combine this to their Social Security income, we see that their overall income is about $250,000. As you can see, this could easily be more than what it was during their peak earning years, meaning they could be paying more in taxes now than they were earlier in life. Again, it impacts that decision between a traditional and Roth contribution. When figuring out which option to choose, you want to get a sense of what your lifetime tax situation might be. There's a couple ways to do this, one of which is looking at your projected lifetime effective tax rate. The way that you would do that is you would take how much income you're going to have in each year and how much taxes you're going to pay to generate your effective tax rate. That's calculated by taking your total tax divided by your taxable income. For example, if you pay $20,000 in federal taxes this year, and your taxable income is $100,000, then your effective tax rate is 20%. With this number, you can compare it to future years. If your effective tax rate is going to be lower this year, really what you're looking more at what your marginal tax rate is, but the effective tax rate is another number that's useful. If your tax rate this year is going to be higher than what it's going to be in the future, you probably want to do a traditional contribution. On the other hand, if it's lower now than what it's going to be in the future, you probably want to do a Roth contribution. When in doubt, I usually recommend going with a Roth because you pull some of the uncertainty out of the equation. If it seems like your tax rate might be similar from year to year, again, I'd probably go with that Roth option. To summarize, choosing between a traditional and Roth contribution has a big impact on your financial situation. Getting this right can limit the need to implement other strategies that we'll discuss today. You do want to make sure you take into account all income in each and every year into the future to figure out which option is right for you. When in doubt, I like to choose the option that increases your overall tax flexibility. This is something we'll look at throughout today's webinar. In this case, it's usually going with a Roth option. The next item we'll look at are Roth conversions. This is an example of an income acceleration technique and is a way to take advantage of suboptimal Roth versus traditional choices earlier in life. The way a Roth conversion works is you take money from your pre-tax account and you move it over to your Roth account. When you do this, you generate taxable income. For example, if you convert $10,000 from your pre-tax account to your Roth account and you're in the 24% tax bracket, then you'd pay an additional $2,400 of taxes this year. This can potentially reduce tax deferred growth on that pre-tax bucket and the amount of money you have right now. So why might you want to do a Roth conversion? Well, Roth conversions make sense if you can pay less in taxes now than what you're going to have to pay later on. If instead of converting it today, when you take required minimum distributions, you're in the 32% or higher tax bracket, you probably will have paid more taxes then than you did now, in which case you can save some money by doing a Roth conversion. To determine if it makes sense for you, you do need to know what your overall lifetime tax picture looks like. With that in mind, let's look at some common situations when you might want to do a Roth conversion. The first is if you're in a lower than normal tax bracket. This often occurs during a gap year, or if you're retired and you're between Social Security kicking in and your RMDs. During these times, you may be in a much lower tax bracket than you used to. You could potentially do conversions and get taxed at a 10%, 12%, or 22% tax rate rather than 24 or 32% later on. Again, you're paying less in taxes now to move the money into that tax-free bucket. Another common scenario is if you're in a higher than normal tax deduction year. This can occur if you have a lot of medical expenses or choose to donate a lot to charity in a certain year. For example, we have a lot of elderly clients that are currently going through long-term care where they pay $100,000 to $200,000 in medical costs. Those medical costs can partially be deducted on their tax return, reducing their overall income and their tax situation. That individual could potentially implement a Roth conversion to move money from their pre-tax bucket to their tax-free bucket at a relatively low tax cost. This can be beneficial for the beneficiaries as well. And a third example of when you might want to do this is to increase your overall tax flexibility. I'm a huge fan of having a lot of tax flexibility, especially in retirement, because it gives you more buckets to pull from. For example, if you need $100,000 to go on a trip around the world, give money for college, or do a huge improvement on your house, and all you have is a pre-tax bucket, then all the money you take out of that will be taxable. However, if you have money in your tax-free Roth bucket, you could take that money out without paying any taxes on it. By doing proactive Roth conversions, it can increase the size of that tax-free bucket and potentially reduce your overall lifetime tax burden. In summary, Roth conversions are an income acceleration technique, and you are choosing to increase your income this year to potentially reduce your income and taxes later on. Consider implementing Roth conversions if you can get taxed on money at a lower rate now than what you'll pay in the future. The next technique we'll look at is known as the mega backdoor Roth. There are several requirements that you need to meet in order to implement this technique. The first is you have to be enrolled in your employer's 401k plan. And I do mean a 401k. It's typically not available with a 403b, 457, or TSP retirement account. Additionally, your 401k plan has to allow for after-tax contributions. Now, we've covered traditional and Roth contributions. Just know that after-tax is a third type of contribution. If you'd like to learn more, you can go back to our first webinar where I discuss this in more detail. For now, just know that this is a third type of contribution, and you have to have access to it to implement the mega backdoor. Another requirement is your plan has to allow for in-plan Roth conversions. And ideally, your plan would allow for automatic daily in-plan conversions. This would move the money from that after-tax bucket to your Roth bucket the next day. This is the best strategy. Otherwise, you may have to manually convert that after-tax contribution yourself. If this is the case, I would recommend setting something on your schedule every month or every 6 months or once a year, something like that, where you're proactively moving the money from your after-tax bucket to your tax-free bucket. Finally, you have to have considerable disposable cash flow to put up to $69,000 into your 401k plan to truly maximize this strategy. Now, assuming those requirements are met, let's look at how the mega backdoor Roth actually works. The first way you would do this is you would max out elective deferrals to your 401k. This year, you can contribute up to $23,000 worth of elective deferrals to your account. Additionally, you need to account for all your employer contributions to your plan. Next, what you do is you take your annual additions limit. This is the most that the IRS allows you to actually put into your retirement account in a given year. For 2024, that's $69,000. You take this annual additions limit and you reduce it by everything else that's gone into your plan. This gives you what your maximum amount of after-tax contributions can possibly be. Then, to maximize this strategy, you would put the most into the after-tax contributions and convert them over to your Roth. Now, you do want to read your plan's 401k summary plan description to determine if you can take advantage of this strategy. Let's look at an example to hopefully make more sense of this. In this example, we have a 45-year-old who puts $23,000 of elective deferrals into his 401k. He works at Microsoft and they contribute another $11,500 on his behalf. Total, he's put in $34,500 into his 401k plan in 2024. The annual additions limit is $69,000. So if we take that annual additions limit, reduce it by the amount of total contributions made, what we get is he can do $34,500 of after-tax contributions that can then get converted to his Roth bucket. So why does this matter? Well, it's a way to get more money into your Roth bucket without increasing your taxable income and improving your tax flexibility and the size of that tax-free bucket. This can help streamline your investments and make it more tax efficient overall, potentially saving you thousands of dollars in taxes over your lifetime. To summarize, the Mega Backdoor Roth is one of the best strategies to increase your tax-free account balances and reduce the tax implications from saving and investing. You'll want to make sure that you review your 401k plan summary plan description to see if you can actually implement it. If you can, I highly recommend looking into doing so. Next, we'll look at the Backdoor Roth. This next strategy, it's similar to the Mega Backdoor Roth, but it deals with your IRA instead of your 401k plan. Now, with Roth IRA contributions, there are income limits to being able to put money into a Roth IRA in a given year. That's different from how a 401k works. There are no income limits for Roth 401k contributions. In 2024, a married couple starts losing the ability to put money into their Roth tax-free account once they hit $230,000 of income. And it's completely lost once they get over $240,000 of income. This means that at this point, the front door is closed on their ability to actually contribute to their tax-free bucket through their IRA. This is where the backdoor comes into play. The backdoor is a way for high earners to increase their tax-free account balances if they otherwise couldn't do so. It also helps improve the overall tax efficiency of their investments, hopefully saving them money in taxes over their lifetime. The way that it works is you make what's known as a non-deductible IRA contribution to your traditional IRA. Now, because you don't get a tax deduction for it, you create something that's known as basis in the account. The IRS says that this basis can be moved over to your Roth tax-free bucket utilizing a Roth conversion without paying taxes on it. Remember, this is different from how a regular Roth conversion works, and that's because of that basis component. Once the money is in your Roth bucket, it gets that tax-free growth of a Roth account. Again, this provides additional tax flexibility to you in the future if you need money for anything and don't want to pay taxes on it. Something to keep in mind, and this is extremely important, is in order to implement the Backdoor Roth, you should have $0 in traditional IRA accounts in your name at the end of the year. Now, this is IRA accounts anywhere that's in your name, including traditional IRAs, SEP IRAs, and simple IRAs. You have to have $0 at the end of the year because of something known as the pro rata rule. The way I like to think about the pro rata rule is like having cream in your coffee. In this scenario, the cream is going to be our non-deductible contributions, and the coffee is going to be the rest of the money that could be in your IRA. Once you put the cream in your coffee and mix it all up, every sip of the drink you take is a mixture of cream and coffee. If you mix it well enough, it'll be an equal mixture of cream and coffee each time. Well, this is the same way conversions and distributions from IRAs take place. If you have that tax-free basis in the account and you go to take money out, it is going to be a mixture of the tax-free money and the taxable money. You can't cherry pick it out, just like once the cream is mixed in your coffee, you can't just take the cream back out again. This is how the backdoor works. The backdoor doesn't work if this is the case because you're trying to move money to your Roth bucket without generating taxable income. Just be aware that this rule exists. There are a couple solutions to it. The first is potentially rolling over your IRA to your employer retirement plan. This could be your 401k, 403b, etc. This takes the money out of that pre-tax account and gets rid of the coffee from the cream mixture. Instead, now you just have that cream and can move the cream from one bucket to the next during that conversion and not pay any taxes on it. The other option is potentially converting your traditional IRA completely to your Roth bucket. Now, when you do this, you will generate taxable income. And you might want to do this if it makes sense to give you extra taxable income this year and you were looking at doing Roth conversions anyways. Now you have the ability to do the backdoor Roth each year moving forward since you've emptied that traditional IRA bucket. You'll also want to be aware of what's known as Form 8606. This is a tax form that you have to fill out at the end of the year that reports all of this information. If you made non-deductible contributions in the past and haven't filled out Form 8606, I highly recommend looking at amending your returns and working with a qualified tax preparer to make sure you're doing things correctly. The same thing goes for if you're trying to implement the backdoor Roth strategy. I do recommend working with a qualified tax preparer as this can get pretty tricky. Now, to summarize, the backdoor Roth is a way for high earners to save more in their tax-free accounts than they otherwise could have. And this allows them to potentially reduce the impact of saving and investing on their tax situation. Again, watch out for the pro rata rule, and please make sure if you implement this strategy, you have $0 in your traditional IRA accounts at the end of the year. Otherwise, you might run into issues. Now we're going to look at what's known as the health savings account and two strategies that are associated with it. Unlike the Roth and traditional contributions, which we just discussed, health savings accounts are triple tax advantaged. This is far better than either of those two other options. That's because you get a tax deduction today for putting money into the account. Remember, you save money for tax deductions. So you are saving money in taxes today. Money grows in the account tax deferred, meaning you're not paying taxes as it grows. And you can take money out of these accounts tax-free in the future if it's for qualified medical expenses. I don't know about you, but I love ways where I can pay no money in taxes legally. And this is why the HSA is my favorite planning tool for working professionals. Now, these are not a use it or lose it plan. That's very important because you can actually take money in your HSA and keep it in there year over year, investing those contributions like it's any other account. Many of you might be familiar with flexible spending accounts, which are use it or lose it. If you put money into those and you don't use it at the end of the year, you do lose the money. That's not the case with an HSA. Finally, to enroll in an HSA, you must also be enrolled in a high deductible health plan. And having an HSA can make a high deductible health plan more beneficial than other options because of the tax advantages of the HSA accounts. Now let's look at some more advanced strategies associated with HSAs. The first is what's known as the shoebox strategy. The way that this works is instead of paying medical expenses as they occur, while you're enrolled in a qualified high deductible health plan, you take the receipts that you receive. These should be itemized receipts, by the way, and you stuff them somewhere safe, maybe a shoebox. In today's digital world, maybe you scan it and put it on a computer. Then later on in the future, you can actually tap into those stored medical expenses and reimburse yourself for them in the future in a tax-free way. Otherwise, if you're taking money out of an HSA account for non-medical expenses, you do pay taxes on those distributions and potentially have to pay penalties on them. However, if you implement the shoebox strategy, you could store up years worth of medical expenses and tap that money later on, potentially in retirement, in a tax-free way. This is a huge benefit of these accounts and provides additional flexibility to you. It also allows your HSA accounts to continue to grow without worrying that you won't have the medical costs to take money out tax-free in the future. Let's look at an example of how this might work. In this scenario, we have another married couple that have $5,000 per year of medical expenses each year between 2024 and 2034. During this time, they're enrolled in a HSA eligible health insurance plan and put the most that they can into their HSA account. Meanwhile, they're paying those medical expenses out of pocket and keeping those itemized receipts somewhere nice and safe. Now, in 2035, at this point, they have retired, so they don't have any other income coming in, but they want to buy a new car. This couple has no other tax-free assets other than their pre-tax retirement accounts. If they need $50,000 for a new car, then all of that money coming out of their pre-tax retirement account would be taxable to them, and they'd have to take out even more money to pay the taxes on that income. Instead, they can use those stored medical receipts and only pay the $50,000 to buy that new car. This provides additional tax flexibility to them and the ability to control their tax and income situation each and every year. This is a huge benefit to you, especially as you get into retirement. The last strategy we'll look at with the HSA is what's known as the non-dependent child HSA. Now, this is a little bit rarer for someone to be able to utilize it, but if you can, it is another nice benefit of these accounts. The way that this works is if you have a non-dependent, non-tax dependent child covered by your health insurance, they can also contribute to a family HSA. Now, this is usually a child between 22 and 25 after they've come out of college and before they get off of your health insurance at age 26. They can contribute up to the family HSA maximum, even though they're a single person. That means they could put in up to $8,300 into their HSA in 2024. This could be a great way for you to help your child grow their nest egg. You could possibly gift them the money so they can make these contributions. They get the tax deduction, they get the tax deferred growth, and they can take money out tax-free later on for medical expenses. It's just another reason that I love HSA so much. In summary, these are a great way to save and invest for the future due to the triple tax advantage nature of HSA accounts. You do have to be enrolled in a high deductible health plan in order to use this strategy. Finally, there are more advanced techniques like the shoebox strategy and the non-dependent child HSA that you might want to look to take advantage of to fully optimize your HSAs. The next plan we're going to look at is the 529 plan and a couple of techniques associated with it. These are another tax advantage account, this time for higher education expenses, although there is a provision where you can take out up to $10,000 per year for private K through 12 expenses as well. The way 529 plans work is you put money into them, the money that's in the plan grows tax deferred, and it can be taken out tax-free for those qualified education expenses. This is similar to a Roth IRA, although there are restrictions on taking money out of the accounts. Something you should be aware of is that contributions to someone's 529 plan are gifts to the beneficiary. Now, if you're only putting a couple of $1,000s in, $2,000, $3,000 a year, it's usually not an issue. But if you start getting up to the annual exclusion limit, which is $18,000 in 2024, you might have some issues. And we'll talk about that in a little more detail during our next slide. Something else that you'll want to be aware of is you can contribute to any state's 529 plan. You don't have to use your state's plan or the state in which your child's going to college or the beneficiary is going to college. In fact, we usually recommend shopping around all the 529 plans to figure out which option is best for you. We often recommend that our clients utilize Utah's 529 plan, which is known as My 529, because of their investment options and relatively low fees. Though it could be possible that your state's plan is beneficial for you because you could get tax deductions for putting money into it. You will want to look at that before choosing a plan to enroll in. Now let's look at the super funding option with the 529 plan. As I mentioned, you can give up to $18,000 per year to any individual without worrying about gifting implications. If you start giving more than that, then you start eating into what's known as your lifetime gifting limit. Now, the super funding option with the 529 plan allows you to give up to 5 times that annual exclusion without using that lifetime gifting limit. That means you could give up to $90,000 this year into someone's 529 plan without worrying about that gifting limit. This can be a great way to turbocharge college savings and help propel you towards your college funding goals. Especially for grandparents, 529 plans are even more attractive for grandparents because of the issues with FAFSA and how student aid is calculated. Now, that's beyond the scope of this webinar. You should be aware that you must file a gift tax return if you elect the super funding option, and you cannot make additional contributions to the 529 plan during that 5-year period of time. The next technique we'll look at associated with 529 plans is extremely new, and that is the excess to Roth IRA technique. This is a way to use extra money in your 529 plan without potentially paying taxes or penalties on the distributions. Now, when I first mentioned 529 plans, I discussed that you get tax advantages for putting money in, right? It gets that tax deferred growth and money can be taken out tax-free for qualified education expenses. However, if you take money out of these accounts for non-qualified expenses, then you are subject to taxes and penalties on those distributions. The excess to Roth technique is a way to take some of that extra money out and move it over to a Roth IRA without paying those penalties or taxes on that rollover. Now, as I mentioned, this is really new, and you just started to be able to take advantage of it this year in 2024. Some other things to be aware of if looking to implement this are the 529 plan must have been open and owned for 15 years before making that transfer. Additionally, contributions made to the 529 plan within the last 5 years are ineligible to be rolled over. So if you've been continuously funding the 529 plan for your child, grandchild, or someone else, then you would have to wait for at least 5 years to move that excess money over into a Roth IRA. And finally, the 529 plan beneficiary and Roth IRA owner must be the same person. This means that if you have a 529 plan for your child, you can't take that excess money and move it over into your own Roth IRA. It has to be moved into the child's Roth IRA. It has to be the same person on the 529 plan as the beneficiary as the owner of the Roth IRA. There's two more requirements that you'll want to be aware of. The first is you can transfer up to $7,000 of excess money in that 529 plan to the Roth IRA in 2024. So you can't put a ton of money into these plans and get it out using this strategy. Additionally, the lifetime maximum that can be rolled over is $35,000. What you want to be aware of is not overfunding 529 plans for beneficiaries, because there can be adverse tax and penalty implications if you do that. This strategy allows you to take a little extra something off the top, but you can't move everything over. It does make 529 plans more attractive than they used to be, but they're not necessarily as attractive as some other options out there because of those implications. In summary, 529 plans are a tax-advantaged way to save for education, mainly for higher education, though there are provisions for K through 12 expenses as well. I do recommend shopping around different 529 plan providers to see which have the best investment options and fees for you and your situation, though you'll also want to take into account any tax deductions you might get for contributing to your own state's plan. Like the HSA, there are advanced strategies such as superfunding the account and transferring excess contributions in your 529 plan to a Roth IRA that you might want to consider exploring and implementing. If you do implement one of these more advanced strategies, I do recommend working with a qualified financial and tax professional, as the logistics get pretty complicated. The next two items that we'll talk about today have to do with equity compensation. The first is known as restricted stock units, or RSUs, and the second are employer stock purchase plans, or ESPP plans. Now, RSUs, as I mentioned, are a form of equity compensation. The way you receive that compensation is in the form of company stock grants. So let's say you work for Microsoft and you receive $100,000 of RSUs in May. When you receive that income, what you're actually getting is a number of shares of Microsoft stock that's going to equal the $100,000 worth of income. Now, there's also some form of restriction on the receipt of that compensation, hence the name restricted stock units. Now, the most common form of restriction is what's known as a vesting schedule. That means you get a chunk of your RSUs each year over a certain period of time. Now, you could get those quarterly, you could get them semi-annually or annually, but there's a set cadence in which you receive them. The two more common vesting schedules are you receive 25% each year for 4 years, or 20% each year for 5 years, though it can vary dramatically. Now, as you actually receive those shares, they are what's known as vested. And the value of those vested shares are taxable to you as wage income. Additionally, that income shows up on your W-2 and your pay stub, so you can track what you're receiving over time to figure out what the tax implications might be for you. RSUs can be a significant portion of someone's overall compensation. Properly managing them can have a huge impact on your overall financial plan. Now let's look at a few key features of RSUs. The first is that the default tax withholding rates for federal taxes with RSUs is 22%. Again, if you earned if you received $100,000 of vested RSUs this year, then your company will typically withhold 22% of that, or $22,000, set aside that to pay for your federal taxes. Now, this is what's known as sell to cover. Usually your company will sell a chunk of the shares to actually pay that tax burden. However, If you are in a high tax bracket in the 24, 32, 35% plus tax brackets, you may not be having enough set aside to pay your tax obligation. This can cause you to have to owe taxes at the end of the year or to generate a failure to pay penalty. You want to avoid these failure to pay penalties as they add to your overall tax burden and reduce your financial situation. Now, one way to avoid this is by utilizing a special withholding election. Some RSU plans allow you to choose before you get the compensation how much you want to set aside to actually pay your taxes. You might be able to choose a withholding rate of 24%, 32%, or some other number based off your personal situation. Now, I recommend that you do a mini tax projection before receiving your equity compensation. Figure out what your income is going to be this year, what your tax deductions are going to be this year, and then factor in your RSUs into that equation to figure out how much you need to withhold to make sure you meet your tax obligation. I also usually recommend selling shares of RSUs as they vest. Now, if you receive $100,000 of RSUs each and every year from your company and you work at that company for 5 to 10 years, then you could have $500,000, $1 million plus of your financial capital, that's going to be your financial assets, tied up in your employer. This can create a lot of risk for you and your financial plan because not only is your financial capital tied to a single place, but your working capital or your income is also tied to your employer. If there's a down market or something happens with your employer, both your job and your assets can diminish significantly. This is why I recommend clients sell these shares as they vest and use the proceeds to diversify across their investment portfolio based off of what fits their needs and their financial goals. Finally, you'll also want to be aware that there are reporting issues that come along with RSUs. Oftentimes, when you sell shares of RSUs at the RSU custodian, they do not report those sales correctly. Instead, you'll have to request the supplemental tax information from those custodians at the end of the year to make sure you're properly reporting this on your own tax return. If you don't do that, then you could end up being double taxed on income and paying more in taxes than you need to. To summarize, RSUs are a form of equity compensation where you receive stock from your employer. You want to ensure that you are having enough withheld from your vested shares to cover your tax burden. This will help limit the potential of facing a failure to pay penalty or owing taxes at the end of the year. Also, ensure that your RSU sales are accurately reported on your tax return. Otherwise, you could face double taxation. Remember, you'll want to get that supplemental tax information from the RSU custodian at the end of the year and provide that to your tax preparer. Finally, with RSUs, I usually recommend clients sell their shares as they vest. This helps reduce your concentration risk in your employer and reduces the risk to your overall financial plan that something bad will happen at work where both your job and your financial capital get eroded. The next technique we'll look at has to do with employer stock purchase plans, also known as ESPPs. With RSUs, we talked about how you receive compensation in the form of company stocks. Now, ESPPs work different than that. The way that ESPPs work is you use a portion of your paycheck and payroll contributions to actually buy stock from your employer. You typically get to do this at a discount to the current price of the stock. Now, the maximum discount that you get right now is 15%, though some companies provide a lower discount than this. You'll want to make sure that you review your ESPP plan description to see what discount you get, as that can make an impact as to whether this strategy makes sense for you and your situation. The way that these plans work is you have what's known as an offering period. Before that offering period, you have to choose how much of your compensation you want to use to actually buy your employer stock. Then, during this offering period, you are putting money into this pool where at the end of it, you actually buy shares of your company stock. That happens at the end of the offering period. Now, something else that you'll want to be aware of is something known as a look-back provision. These provisions can be hugely beneficial to ESPP plans and can make a lot of sense to use this plan if they have a look-back provision plus a discount, especially if that discount is 15%. Now, without a look-back provision, what typically happens with an ESPP plan is that discount is based off of the price at the end of the offering period. With the look-back provision, you may be able to use that discount and have it be based on the price at the beginning of the offering period or the end of the offering period, whichever is a lower price. So let's look at an example of how this would work. Let's say that at the beginning of that offering period, your company's stock is selling for $10 a share, and your discount is 15%. That means that you have the option to buy the stock at $8.50 a share. That is 15% less than the current fair market value. Now, over this offering period, which can range, oftentimes it's 6 months, a year, though the range can go anywhere from 3 to 2+ years. 3 months to 2+ years. Now, during this offering period, if your company stock has gone up in value to say $12 a share and you didn't have a look-back provision, then you would have to buy the stock at $10.20. However, with this look-back provision, you get to buy the stock at $8.50, and it's currently worth $12 a share. Now, I don't know about you, but I would much rather prefer paying $8.50 a share for the stock than $10.20 a share for the stock. And then what I usually recommend clients do is once this offering period ends, I usually tell them to sell their shares as soon as they can. This helps lock in that discount, especially if they have this look-back provision, and use that extra money for their other financial and life goals. Now, otherwise, you start running into the same issues that you have with RSUs, where you start building up potentially concentrated positions in your employer stock. If you wouldn't use this compensation to buy shares of your company stock without having ESPP plan, I probably wouldn't keep those shares after the fact, though it can be a little bit more nuanced than that, but that's beyond the scope of this webinar. In summary, ESPP plans are another form of equity compensation. The way they work is you use a portion of your salary to buy shares of your company stock, and it's typically done at a discount. If you have a look-back provision and a discount within your ESPP plan, it usually makes sense to enroll in it and take advantage of the plan, which can help propel you towards your financial and life goals. Finally, I usually recommend selling the shares of your ESPP plan as they vest to lock in any discount you received and take some of the risk off the table. The next topic we'll discuss has to do with tax-efficient donations to charity, and these are donor-advised funds. Now, before we discuss donor-advised funds, I do want to talk about charity a little bit. You can get potential tax benefits by donating to charity. That's because charitable donations are itemized deductions. If you have enough itemized deductions to get over the standard deduction, then it can start reducing your taxable income and the amount of taxes that you have to pay in a given year. While you can get some benefits from donating to charity, it does reduce your overall net worth. For example, if you are able to get a $10,000 deduction by donating to charity and you're in the 24% bracket, then what you will see is you will reduce your taxable income and the amount of tax that you have to pay by $2,400. However, you still donated $10,000 to charity, so $10,000 left your net worth. That means that donating to charity in and of itself is typically not a great idea for your overall financial situation. However, if donating to charity and charitable giving is a main goal of yours, then using a donor advised fund is a great way to do so in a tax efficient manner and get the biggest bang for your charitable donation. So let's look at how a donor advised fund works and a few key features associated with it. This is what's known as an income reduction technique. That's because it reduces your taxable income so long as you get over that standard deduction. It is also, as I mentioned, a tax efficient way to donate to charity. It's tax efficient because you can potentially get over that standard deduction if you couldn't otherwise do so. The way that a donor advised fund typically works is you set up this fund at some custodian. We typically use Fidelity Charitable, but there are other options out there. Now, that fund, you can move some of your you can donate some of your appreciated securities to it. These are going to be things like stocks, bonds, mutual funds, ETF, anything that's gone up in value significantly. Those are the things that you might want to move over to your donor advised fund. The best option is whatever has gone up the most. That's because you get some of that appreciation, which if you sold those stocks, you would have to pay you would generate taxable income for doing so. You get that out of your account and move it over to charity where you don't have a tax implication from them selling it. Then you get to choose to make grants out of your donor advised fund moving forward to satisfy your charitable giving goals. Now let's look at an example of how this might work. Let's say that this year you plan to donate $5,000 to charity, and in fact, you plan to donate $5,000 to charity indefinitely into the future. Now, if you do a $5,000 charitable donation today, it's not going to get you over that standard deduction. You don't have a lot of other itemized deductions, so you're not going to get any benefit by giving to charity, even though it is a goal of yours. Instead, what you could do is you could donate several years worth of charitable grants, charitable giving goals over to charity into your donor advised fund this year. Maybe you donate $50,000. Now, since you've donated more than what the standard deduction is, you get a higher deduction than that and can itemize your deductions. You get a benefit from actually donating to charity at this point. So what happens here is you have this money now in your donor advised fund. That is a charitable organization in and of itself, which is why you get that charitable deduction. Then you can make $5,000 grants from your donor advised fund to charities of your choosing into the future. You could do this over potentially 5, 10 plus years. And if you invest your donor advised fund, which is an option for many providers, then that fund could potentially grow enough into the future where the earnings within the fund can fund those grants that you want to make. This is a great way to donate to charity in a tax-efficient manner and satisfy those charitable giving goals of yours. In summary, a donor advised fund is a tax reduction technique. It is a way to give to charity in a tax-efficient manner by potentially batching your donations, donating a larger amount to your fund this year, and making smaller grants out of your donor advised fund each year into the future until it's depleted. It also takes some of the cash flow burden of donating to charity off of you, especially in retirement. If you were otherwise going to give $5,000 per year of cash to charity, you probably would have had to sell some stuff in your investment portfolio to generate that cash, which could have caused taxable income. Instead, you can use the donor advised fund to do this at a relatively low tax cost. The last thing we are going to talk about today is what's known as tax location. Tax location brings together much of what we've discussed throughout this webinar series, and properly implementing it can significantly reduce your lifetime tax burden, especially for both high earners and or high net worth individuals. The way that tax location works is you choose specific investments to go into specific accounts. As we've discussed today, there are 3 different types of tax buckets and accounts. There are taxable accounts, there are tax deferred accounts, and there are tax exempt accounts. Now, taxable accounts, this is going to be your taxable brokerage account. Tax deferred accounts, this is typically going to be your traditional and pre-tax IRA, 401k, 403b, etc. While your tax exempt accounts are going to be your Roth and HSA accounts. Each of these buckets have their own characteristics. For example, with taxable accounts, income generated within it is taxed to you each and every year. Additionally, when you sell something in a taxable account, any appreciation is taxed to you at capital gains rates. Now, as you might recall from our first webinar, capital gains rates are lower than ordinary income tax rates. Now let's look at how tax-deferred accounts work. Remember, these are your traditional pre-tax accounts. The way that these accounts work is you pay no money in taxes while the assets are in there, and you pay ordinary income tax when you make withdrawals. Ordinary income tax are going to be higher than capital gain tax rates. This is going to be important in a minute. Additionally, these tax-deferred accounts are usually subject to required minimum distributions, which means you have to start paying taxes and you have to start taking money out of these accounts in the future and paying taxes on that money, whether you need the income or not. And finally, the third and last bucket are your tax-exempt account. Remember, these are your Roth and HSA accounts. With these accounts, you pay no money in taxes when you take money out of it. So let's look at which asset classes you might want to put in each of these to take advantage of the asset classes characteristics and the accounts characteristics. First, with taxable accounts, you want to put in asset classes that have higher returns and are relatively tax efficient. You really want to prioritize the tax efficiency within these accounts because, as I've said, you pay taxes on any income generated within a taxable account each and every year. You want the high return assets here as well, because when you sell those assets, you potentially pay tax at capital gain rates. Additionally, if you pass away with money in a taxable brokerage account, they get what's known as a step up in basis. So your heirs do not have to pay taxes by selling those assets. This is a more tax advantaged way than the way tax deferred accounts can work. That's because tax deferred accounts, you have to recognize ordinary income taxes on money taken out of these accounts. So with tax deferred accounts, you want to keep the overall size of it as low as possible relative to everything else. That's why you want to put your lower return assets in these accounts. Now, you might be asking, Kyle, why would I want any low return assets in my portfolio at all? I want my accounts to grow as much as possible. Well, this is where something known as asset allocation comes into play. Asset allocation is the mix of stocks and bonds that you choose for you based off of your goals, risk tolerance, and what you want out of life. Typically, there's going to be some mixture of higher return and lower return assets in that mix. When that's the case, you want to put your lower return assets in the tax deferred account whenever possible because it stunts its growth and reduces the size of your RMDs later on, thus reducing the amount that you pay in ordinary income taxes. Finally, with your tax exempt accounts, you want these to grow as much as they possibly could. The reason you want your tax exempt accounts to grow as much as they can is you never pay taxes when you take money out of them. So it gives you more flexibility to have money in these accounts, and you want to encourage that growth. Let's look at a general rule of thumb for asset placement. First, income generating stocks, typically you want to put these in your Roth accounts. Now, you want to put stocks in the Roth account because stocks tend to have higher returns over time, though that's not guaranteed, as we know. Additionally, you want the income generating stocks here because otherwise, if you're getting that income in one of your taxable accounts, it's going to be taxed to you each year, which reduces your return and how much money you actually get after paying for taxes. Now, for your taxable account, you typically want to put your growth stocks here. You put your growth stocks in taxable accounts because they tend to kick off less income than other items, and they usually grow at a decent rate. This is a more tax efficient asset class than income generating stocks or bonds. Finally, you want to put your bonds in your IRA because bonds tend to have a lower amount of, typically grow less than stocks do, and tend to have a lot of income coming out of them. If these bonds are in your taxable account, that income is going to be taxed to you. And again, you want to cut down the overall growth of your portfolio, of your IRAs and your tax deferred accounts, so you cut down on your RMDs. In summary, tax location brings together a lot of what we've discussed today. It works by placing investments in certain accounts based off of the assets characteristics and the accounts characteristics. By doing this, you can reduce your overall lifetime taxes. It does this by reducing the size of your RMDs. Remember, this is going to be ordinary income to you. It reduces the size of your taxable investment income each year, which again is going to be taxed to you. And finally, it helps encourage the growth of your tax-free buckets, which provides additional tax flexibility and the capability to take money out of those buckets later on if you need to do so. To conclude, choosing the correct tax planning tips can make a dramatic difference on your overall financial situation. Since taxes are one of your largest lifetime expenses, optimizing your tax situation can allow you to keep more of your hard-earned money and use it towards your other financial and life goals. Today, we discussed many of the most common tax planning tips and strategies we use with our working professionals every day. Hopefully, you've picked up a few techniques that you can use to improve your situation. If you have any questions, please reach out to the Milestone team through our website or by sending us an email at info@milestonefinancialplanning.com. And on behalf of myself and the rest of the Milestone team, I'd like to thank you for attending and hope to see you at our next webinar on August 15th. Thank you and have a great day.